Mark Matthews is joining us, head of Bank Julius Baer, to take us through his views on the markets and the current momentum that we're seeing. Mark, good morning. It's been an interesting run the last few days, and particularly as we count down to elections, everyone seems to be talking about the fact that possibly the market's pricing in, a positive outcome. What's your view, considering we're now outperforming our peers in terms of, a view from the outside? How are the Indian markets looking to you at these levels and what we're currently trading at?
Well, there's the short term and the long term. So with the short term, I think the election is important. And from what I can tell since the Kashmir incident, there's been an increase in the polls and the BJP standing. And that is probably one of the reasons why you've seen a pickup in foreign flows into India. The other reason would simply be that it was a big laggard relative to China in the first couple of months of the year. And what happens after that really is contingent on the election. If the BJP is able to form a majority without the help of any coalition partners, then I would expect to see a lot more foreign flows into India, because one thing that foreigners have liked in the past 4 or 5 years is the reform story from this government. And then if it doesn't happen, I really can't say. I would imagine that either you get some profit taking or at least a pause in the inflows. The longer term story with India is one that will always interest foreign investors because it has the best demographics of any large country in the world. So 1.4 billion people now, 1.7 billion people by the end of this century. China is going from 1.4 to 1. So that structural story for India, I'm terribly sorry, is the one that I think people still appreciate.
That's the perils of live television. No worries, Mark. We'll get right back to you then and talk about your outlook on the valuations, because you're still not comfortable with the valuations that the Indian markets command. I believe that you believe that we're staring at very expensive valuations compared to some of the other emerging markets as well.
Absolutely. India and China have the same return on equity. It's about 12 to 12.5%. But in India, you're paying 17 times for that. In China, you only pay 12 times. Now, I would argue that the Indian premium over the long term is merited for exactly the demographic growth trajectory that I just described to you. And in China, it's the reverse. So that's why I think India is a structural story and China's more of a cyclical story. And when I say cyclical, I mean stimulus on, stimulus off. So last year, Chinese turned the stimulus off. They deleveraged, which they clearly overdid. In retrospect, they turned the stimulus back on around last summer, and we're now starting to see that percolate through into their economy. And typically with these kind of command economies, you overdo it when you stimulate and when you take the stimulus away. So probably, I think this is what the market's starting to realize, China's growth will be stronger than people anticipated this year. But longer term, coming back to the demographic profile, that's where I think most people would be willing to still pay up for India. I guess the question is, what is the price that you should pay? Is 17 times the right price, or is it 15 or 20? That I don't know. But when you're looking really long term, I guess it's not as important whether it's 15 or 17.
Fair point. But what is it that you would bet on in the longer run, though? Would it be consumption or investment?
Well, the investment is a pretty big missing ingredient in India. So I hesitate to say when that's coming back. People have been calling for a pickup in investment for quite a long time. It's been elusive. In the absence of it, I think the consumption is the way to go. And maybe you can play both as a hybrid through well-run private sector banks.
Those banks a little bit more, because we've got the Nifty Bank just been trading at record highs and a lot of momentum, particularly on the private side. Just talk us through your strategies there, Mark, the factors you're tracking. I'm not sure if you're going to share any particular names with us, but just your views on the banking space.
Well, it's a bifurcated banking space. So you've got the PSUs that are burdened by NPAs that, of course, the RBI was trying to get them to work through. And I think that is going to keep them really from being able to lend a lot. And so there is a window of opportunity for the private banks to do that lending instead. And I don't get the sense when I look at households in India that they are over-levered. It's kind of the opposite if you look at credit cards and things like that and compare it to the rest of the world. So I think well-run private companies that are doing business, private banks, private financial companies doing business with households, be it mortgage lending or credit card lending, that would be the way to go.
Okay, and what's the outlook on the overall liquidity situation as well? We've seen the currency being bolstered quite significantly on the back of FIIs pouring money into Indian equities. What do you think, Mark, is leading to the turnaround in the FII view?
Well, there are multiple factors. So I mentioned in the beginning the election. The polls are suggesting it could be a majority for the BJP, and I think that's probably one thing. The other would be the dovishness of the Federal Reserve having brought the 10-year Treasury all the way from 3.3 down to 2.6%. People are now hungry for yield, and India does have yield. Of course, what keeps people away from India traditionally is the weakness in the currency, but we're in a little bit of a Goldilocks space right now because there's really no sign of inflation. 2.6%, I think, was the most recent CPI inflation reading in India. So, and you have a central bank, which I think we can safely say has become more dovish. So you add it all together, I think that might explain why the foreigners are moving into Indian financial assets.
Mark, would you still say that because of the uncertainties and the impending election, which is a very big trigger, it would be safer to be in large caps? Because of late what one is seeing is that the broader markets, that's the mid and the small caps, have begun a solid recovery and more stronger than the benchmarks, if I may call it that. But would you say that just be a little wary and stick with the large caps for now?
Well, I think it's a binary outcome. If the government wins, the market will go up, and probably therefore the mid caps will outperform. And if it doesn't, the market will go down, and then large caps would go down too. So I don't know really. I think it's, as I said, it's a kind of binary event, and I don't know how you could play it to try to make money in both outcomes. Unlikely.
All right, Mark, appreciate you joining in, giving us a sense as to how you see the markets faring up until elections, post that, the view on banks as well as the valuations.